As investors, we want to own the best quality companies with the highest probability of generating strong cash flows long term. Is a good quality company where all the T's are crossed and all the I's are dotted a very good investment? Not always. And the good news is that prices in the market are set on any given second, on any given minute, on any given day. And they're very much influenced by short-term factors, which means that valuations overshoot when people feel good and they undershoot when people feel bad. And as long as we can detach ourselves from the crowd, maybe understand the company and its valuation a little bit better, we might be able to buy companies at a margin of safety. And the longer the time horizon you have, the better the probability that you have to make money. In today's update, we're going to address the question as to what price should we pay for an individual asset. There are different models that can help you understand whether there's a margin of safety, and one of those is what's known as the discounted cash flow model. It'll break down the terminal value, the intrinsic value, relative to its market value to give us an idea as to what a security might be worth based on the future present value of its cash flows. So in today's update, we're going to break that down from scratch. We're going to understand how to calculate and input the data and really understand what it is that we're looking at to give us an edge when we're buying an individual security. Let's get straight into it. We're going to build this discounted cash flow model out from scratch. Before we talk about anything to do with this, it's important to understand where this is actually valuable. Many people use a discounted cash flow model for all types of businesses. That's a big mistake. And the reason being is there's a lot of assumptions that go into these models. And if you put trash in, you're going to get trash out. So I'll give you an example. Let's say we have a high growth company. It's currently net income negative. It's currently EBITDA negative. It's going to be very difficult to have any sort of visibility on future estimates. You put trash in where it's very uncertain what their future cash flows are likely to be, if any, you're going to get an intrinsic value out that doesn't make a lot of sense. It might be way too high, way too low, and the quality of that estimate is really not going to be good. Now, if we're looking at a company that's in an established market, we think it's trading below its fair value, but we don't know. It's consistent, good quality capital allocator, and we've got a reasonably good chance of estimating its future cash flows. That might be a better, much better opportunity in order to use a discounted cash flow model to figure out whether we're buying a company at a margin of safety. So it really depends on the quality of the data that you're putting in. The assumptions that we use are very important as well. We want to be as agnostic as possible. The problem with models are people can adjust them and make them look favorable depending on what their outlook is on a specific business. We want to be very agnostic, and we want to make sure that we're giving ourselves the best opportunity to understand what a fair value is. As Warren Buffett says, I would rather be a little bit right than 100% wrong. And what a discounted cash flow model can do is it can give us an idea as to whether a business is undervalued or overvalued. And that's the benefit of it. Are we buying it with a margin of safety? So in today's example, we're going to be analyzing a company called the Packaging Corporation of America. And we're going to understand what its terminal value is, its intrinsic value. And when we measure that against its market value, we're going to be able to understand what the potential gain or loss in this investment would be, and the internal rate of return based on those irregular cash flows. So if you would like to pause the video here and copy all of this down into a spreadsheet, we'll do this together. Some of it might look familiar. The weighted average cost of capital. Weighted average cost of capital, we do have a video breaking this down. Super simple. But again, it's about the quality of data that goes into the company, that goes into the model, and then it'll spit out much better quality if you put good quality in. And I'll explain why we're going to use the weighted average cost of capital in just a moment. So we're going to start off our inputs and some of our assumptions. It's going to be very important to be fair and concise here. And then we're going to have a look at our estimates into the future for EBIT, tax, depreciation, amortization, capital expenditure, and changes in net working capital. That'll spit out our unlevered free cash flow. We'll understand based on our exit and our entry what those adjusted cash flows are likely to be, and then we'll be able to calculate those valuations. Okay, let's start off here, top left. Tax rate, the effective tax rate. We want the average tax rate moving forward. Discount rate. I see many people use, for this industry, you need to use 6%. For this other industry, you need to use 8%. This industry commands 15% discount rate. Why? Why 15%? Why not 5% or 25%? And that was a question I always had. And when we're looking at the discount rate, it's important to understand that every business has a different capital structure. Some businesses have more debt than equity in terms of financing, and therefore they might be more sensitive to interest rates. And so the cost of capital might be very different when you're looking at the weighted average cost of capital. So because each business is capitalized differently, I think it makes more sense to use the weighted average cost of capital here. Next up, we have the perpetual growth rate. At what rate can this business grow in perpetuity, forever? So we're looking at GDP here in the United States. Over the past decade, GDP has been in excess of 2.5%, 3.5%, depending on the year. And so over the next decade, given that debt levels are a lot higher, certainly from a sovereign perspective, we'd be assuming possibly 1% is fair and possibly even conservative for US GDP growth. So I'm going to go ahead and put that in there. The multiple, we're going to be looking at the average enterprise value to EBIT over the past 12 months, over the past decade. We're going to get the average, what the market was willing to pay on average over the past decade. And we're going to stick that multiple in there. Transaction date and end of fiscal year. So most end of fiscal years would end on the 31st of December, but they can end in any month. So it's important to check that out. Some companies might end in March. Some companies might end in January, July. Most end in December. But between now and the end of fiscal year, remember, we're calculating the present value of future cash flows. Future cash flows being the key word, future. So if we calculate 2022's cash flows, that's not really going to give us a fair estimate because we're 88% through the year already. There's only 12% of the year, so we should only factor in roughly 11-12% of cash flows into the end of the year. So today's transaction date, which is the 24th of November, this is where we're planning on taking our position. And we want to understand what the future cash flow from today is up until the end of the year. And the end of fiscal year, we'll have a look at this in a moment, but in this case, it's the 31st of December. So we're going to go ahead and put that in there. I'll show you where you can find out where the date is. So let's start filling all this in. We need our price, outstanding shares, debt, cash. So let's start off with tax rate. We're going to use ticker terminal. Stick in our ticker. If you guys want to use ticker terminal, there is a link in the description you can follow along. I think on the free version you'll get most of this information, but you might need to upgrade to get the estimates over the next 4 years. So we're going to use Packaging Corporation of America, for example. Ticker is PKG. And what we're going to do is we're going to go over to our income statement. We want to know what the effective tax rate is. So if we go down to the bottom here, you'll see the effective tax rate. Now, look, prior to 2017, 34%, and then something happened in 2017 and the tax rate dropped lower. Well, what happened was, with Donald Trump as president, taxes were cut. And then you can see from there, 3 of the 5 years, we've seen an effective tax rate roughly 24%. 23.96, 24.06, 24.14. 1 year was 19, another year was 27. Let's just assume over the next 4 or 5 years, tax rate's going to be 24%, which has been roughly the average over the past 5 years. So we're going to take the tax rate, the effective tax rate, we want an average because it's over a number of years, and we're going to use 14%. So 24%. So it's 0.24 here. The discount rate. Now, with the discount rate, there's a lot of this information that we could use if we continue filling this out. So let's come back to the discount rate a little bit later. Next up, we have our multiple. We're looking at enterprise value to EBIT, and we're looking at the average over the past 10 years. So back over to ticker terminal, valuation, and we're looking for trailing multiples, enterprise value to EBIT, and we want the past 10 years. As you can see there, the mean has been 12.62. That's been the average. We're currently at 9, but the average has been 12.62. So we're going to take that there, 12.62 as our estimate in terms of the multiple. We're going to round it down to 12.5. We're going to use 12.5 as our estimate. So 12.5 goes in there. The price, very simple. We're going to pop back on over to ticker terminal, 133.35. Simple stuff, really simple stuff. Next we have outstanding shares. Okay, with outstanding shares, we're gonna get it from the SEC. SEC.gov. We're gonna go file, company filings. We're gonna key in the ticker here, PKG. And at the very top of the 10Q and 10Ks, you'll find the outstanding shares. Now in certain circumstances, in this case it's easy. We have common stock, one class of shares, 92.5 million. Sometimes you might have a couple of different classes of shares. You might have preferred shares, common equity. You might have different classes of common equity. Maybe one has voting rights, another one doesn't. It doesn't matter. Just count all of the shares that show up in this category as the total outstanding shares. So as of the 28th of October 2022, the registrant, which is PKG, had an outstanding 92,534,480 shares of common stock. Just click on that. We're just going to copy this and we're going to paste it into our spreadsheet here. Next we need our debt. So you guys know where to find debt. Pop over to ticker terminal. We're going to go to our balance sheet. Now, important not to go down to the bottom and see total debt, because we want interest-bearing debt, not including capital leases. So as you can see here, we've got long-term debt. So let's pull up our calculator. Long-term debt is 2473.1. Is there any short-term debt? Short-term borrowings? No. Is there any current portion of long-term debt? No. So the only interest-bearing debt that the company has is 2.473 billion. So what we're going to do is pop back on over to our spreadsheet, 2473100. We're going to change that to dollars. So it is, there is too many zeros. 2.473 billion. Okay, how much cash do they have? Back over to the balance sheet again. At the top of the balance sheet, I normally include cash and short-term investments, because those short-term investments might be bills, a couple of months, 1 month, 3 months, something like that. And so it's going to convert into cash very soon. 726,400,000. So we have 726,400,000. We're going to pop that in. Again, 1 0 too many. So we've got 726 million in cash. Now, let's pop on over and do our discounted cash flow model. We zoom out a little bit. What are we looking for? Our total debt. So if we go equals, we have debt already over here. Great. Market cap, super simple, equals. We have the price times outstanding shares. And that'll give us the market cap. Now we need the weight of each. Right, so let's zoom in here. How do we get that? Super simple to anybody that went over the weighted average cost of capital video. We go equals. And we're going to divide total debt into the total capital structure divided by debt plus total market cap. So market cap is the marketable equity of the company, and we want the total market value of the debt. Both of those together is the capital structure, and we want to understand the percentage of debt relative to that capital structure. So debt is 16.7%, and equity obviously makes up the rest, which is 83.3%. Now we need our risk-free rate, usually a 10-year bond yield. I appreciate it's about 3.8% as of right now. Let's use 4%. Equity risk premium, about 5.6%. And let's change that to percentages. And the cost of equity then is essentially our risk-free rate. Let's move both of those up. We need beta. Cost of equity is risk-free rate plus equity risk premium multiplied by beta. So let's figure out what beta is. If we pop back on over here to Google, we want to go to finance.yahoo.com. We're going to go PKG, Packaging Corporation of America. And we're going to go to statistics. And under statistics, it has 5-year beta. Now, if you want to understand beta, why it's valuable, how it's valuable, we do have a video, how to break it down and calculate it yourself. There's a lot of websites that share beta, but if you want to check out that video, there's a link just above if you want to check that out. Here you can see beta over the past 5 years using monthly data for Packaging Corporation of America is 0.85. Let's pop back on over to our weighted average cost of capital, 0.85. So the cost of equity is equals the risk-free rate plus equity risk premium times beta. And if we put that, maybe we can put a underline there just to show that that there is the answer. So the cost of equity is 8.76%. Now we need the cost of debt. Interest. Where do we get interest? Back over to ticker terminal. Income statement. Interest expense. Interest expense is $76.5 million. Let's pull up our calculator. 76.5. Let's pop on over to our balance sheet. Let's have a look at all that debt, which was all long-term debt. Let's pull up our calculator again. So we're going to divide the interest expense by total debt. 2473.1. And that gives us, if we multiply that by 100, that gives us an interest expense of 3.09%. So we're going to input that into our data here. 0.0309, 3.09%. Now the tax rate we already have. So we're going to take the tax rate from here. And we need to calculate the after-tax cost of debt. There's a tax shield here, right? What do we mean by that? Well, interest is a tax-deductible expense. So we need to understand what the after-tax cost of debt is if we can expense that interest. So we go equals interest multiplied by open brackets 1 minus the rate. And that gives us 2.35%. So again, let's just make that a little bit more important or prominent there. And what we're going to do now is calculate the weighted average cost of capital. How do we do that again? Well, we open our brackets, we take the cost of equity, we multiply it by the market cap percentage of total, the equity percentage of total capital structure, close brackets, and we add that to the after-tax cost of debt, multiply by its weighting. Okay, I forgot a bracket. So 7.3% is the weighted average cost of capital. So over here, we're going to use that as the discount rate. Equals 7.3%. So 7.3% is our discount rate. It's not a random number. It's based on the cost of capital for this business. Okay, now let's start filling out the rest of this data. Equals, we have a transaction date, which is today. And then we have the end of year, which is the end of fiscal year. And between this date and this date, we're going to make a certain amount of cash. So we got to factor that in. After that, we're going to calculate the coupons of cash flow all the way out to 2026. So 31/12. Let's just drag this across. Okay, so this here is going to be our entry. And this here is going to be our exit. This here is going to be the current fiscal year. So we're going to have 0, 1, 2, 3, 4 years. Now we need to understand what the fraction is, the year fraction between both of these. How much of the cash flow do we need to consider for the following year? We're going to understand what the unlevered free cash flow is for the full 2022, but that's not fair. It's not fair to use the full year of cash flow because there's only about 5 weeks left of this year. So we want the future value of cash flow, the present value of those future cash flows, not what's already happened throughout the year. So here we go, equals year fraction, whoops, it should be year, not yeet, equals year frac, open brackets, this, comma, this. So there's about roughly 0.1 left in this year. And then we just drag this across. And you'll see that all of these are ones because it's looking at the fraction between the last couple of years. Okay, now we need to input some data. Let me just make these bold so we understand. Let me just make all of these bold so we understand what we're filling in here. Okay, so we need our EBIT. Where are we getting those estimates for? We're getting them from Ticker Terminal. If we pop on over to Ticker Terminal and we click on estimates, all of these estimates are coming from the Capital IQ data set from Standard & Poor's. So all of the analysts that are sitting in their office 24/7 coming up with forward projections. There's many of them. We're getting the average and it's built into ticker terminals. So look, I don't understand why I would try and come up with these estimates myself, because I'd be lacking an awful lot of information. But many investment banks have analysts that entirely work on these industries, sectors, and companies all day, every day. So these estimates are going to be far better than what I could give. And the reason why I'm very comfortable taking them is because, as Buffett said, we want to be somewhat right, which is better than being 100% wrong. It's not about being 100% right, it's about being somewhat right. I'm sure he didn't say it exactly like that, but you get the idea. So we're looking for EBIT right here. So if we click on this, we're looking from 2022 into 2026. As you can see, we already have it up there. So I'm going to input all this data. Essentially what I'm going to do is just skip forward and just copy all this into the spreadsheet. Okay, now that we have all of our EBIT in, tax rate's very simple. Equals our EBIT, our before tax income. We take that and we multiply it by our tax rate, our effective tax rate. So what we want to do is, because we want to keep it on that tab, see that D16? We're just going to put cash tags around it. And we're just going to drag it across. And that's going to keep it on. We drag it all the way across. And that'll give us our tax rate, or our tax expense every year into 2026 based on these estimates. Next up we have depreciation and amortization. Where do we get that from? Same place. If we pop back on over here, we look at estimates. We scroll down here, we'll see depreciation and amortization. So I'm going to skip ahead now, and I'm just going to input all this into the spreadsheet. And once that's input, we're going to do exactly the same for capital expenditure. So if we pop on over to ticker terminal, you'll see down below here we have capital expenditures. It's very simple stuff, just copying and pasting all this in. Okay, that was the easy part. EBIT, tax, depreciation, capital expenditure. So if you remember, when we're looking at the income statement, cash flow statement, depreciation and amortization is an expense, but it's a non-cash expense. The capital expenditure is the real expense up front, and depreciation and amortization is a non-cash expense. So we have to factor those in when we're trying to understand what the cash flows are. Next, we're going to have a look at changes in net working capital. Net working capital we also have a video on. I'll leave a link in the description if you'd like to understand it a little bit more and sort of reference it with equity, the book value of equity. Changes in net working capital is essentially the difference between current assets and current liabilities over two different periods. And so if you look at current assets, very liquid assets, receivables, cash, inventory, they're somewhat liquid. Inventory with the asterisks over it. Liabilities, short-term, essentially we're looking at short-term liabilities. It's a little bit more difficult to understand where we're going to be longer term with changes in net working capital, because we could end up seeing a boost maybe in sales that wasn't previously projected, meaning accounts receivables push higher, meaning we start to see net working capital actually increase, not decrease. Or we could start to see that the company is paying down its bills at a faster pace, or receivables are slowing down, or whatever it may be. Inventory is being sold off, cash is being depleted, it's moving into investments, and that would ultimately mean a drain in net working capital. It's a little bit more difficult to forecast this. So what I end up doing in this scenario, I pop back on over to the cash flow statement, and I have a look at the trend over the past number of years. So below the cash from operations, you can see it says memo, change in net working capital. That's essentially what we need to factor in, but we're trying to forecast this into the future. And when we look at this longer term, there's been periods where we had positive net working capital, periods where it's negative, very slightly. There's not huge changes in net working capital. It's slightly towards the downside. So I'd be more willing to say net working capital is probably going to be negative 40 million to 50 million. Taking this anomaly out, over the long term, it's been somewhere, it averages out somewhere around there. So over the next couple of years, I think if we use, let's say, negative $50 million, it might be a fair representation of what's happened since 2003. Right? So we've got a long history here. So over the next couple of years, we're going to factor in changes in net working capital at $50 million per year. I'm just going to drag that across. Again, a little bit more difficult to understand like what the changes in net working capital are going to be over the next couple of years. It's much harder to figure that one out. Now, what we need to do is, let's put an underline here. We're going to calculate the unlevered cash flow. So the unlevered cash flow, very simple. I've made it very simple. We've got EBIT, and then we've got a minus sign beside the tax, a plus sign beside the depreciation and amortization. So tax is a real expense. Depreciation and amortization is an intangible expense. It gets added back on the cash flow statement, and then capital expenditure is obviously a real expense that comes out of our operating cash flow to give us our free cash flow. And then the changes in net working capital can give us an idea as to what's happening with working capital. So that should be a negative. So let's just drag the negative across. We're expecting working capital to be negative. So equals, we've got EBIT minus tax plus depreciation minus capital expenditure and minus working capital. We're going to drag this across. And that there is what's known as our unlevered free cash flow. So now what we need to do is factor in what our entry price is. So we need to exclude out what today's market value, its enterprise value is. We need to exclude that out here. So in order to do that, we have to pop on over here, the market value, and we need to fill this out. So equals market cap. What is the market cap? It's the outstanding shares times the price. We've already calculated it. Next, we need to add the debt here. Remember, enterprise value is debt plus equity minus cash. That's what we're trying to figure out. So we got debt. So in here, we're going to go equals debt, cash. So we're going to go equals cash. And then in the enterprise value, we're going to go equals the market cap plus the debt, total capital structure minus cash. Why do we minus cash? Well, let's say I want to go and buy this business. And let's say the business produces positive income. Why would I pay for the cash in the bank? I don't want the cash in the bank. I don't want it at all because it's not productive. So the owner just keeps this cash and gives me the business that produces cash. Make sense? So that's what the enterprise value is. And we're going to use that here. So we go equals this minus this. And it should come up as a minus. So we're going to put that in red. So now what we need to do is figure out what our exit is in 2026. And our exit is the terminal value. So let's start off here with perpetual growth rate. So the calculation for perpetual growth rate is equals 2026, well, open brackets, 2026's cash flows, unlevered free cash flows, and we are multiplying that by 1 plus the perpetual growth rate. And what we're doing is we're dividing that by, open brackets, the difference between our discount rate and our perpetual growth rate. And I gotta close the bracket one more time there. So the perpetual, factoring the perpetual growth, the terminal value is 13,373 billion. Now we're gonna look at enterprise value to EBITDA to figure out what the valuation is, looking at this multiple here. Remember, this here is EV, enterprise value to EBIT. So how would we come to the valuation here? Because we want the average. We want a fair terminal value, looking at it from two perspectives. So if we go equals, what we're going to do is we're going to take the multiple multiplied by, open brackets, what is EBITDA? It's EBIT plus depreciation and amortization. So we're going to understand what the enterprise value to EBIT is. And then what we're going to do is figure out what the average is. So let me just put a tick underline there. And we're going to go equals AVE or AGE, average, number 1 and number 2. And it's going to give us 15.78 billion. So that is our exit. So now we have our entry and our exit plus the cash flows along the way. Next, what we need to do is we have calculated the terminal value. We've calculated the market value. We need to figure out what this intrinsic value is, and then we need to work back and figure out whether there's a margin of safety and what that internal rate of return looks like. So we're going to be using XNPV formula here. So equals XNPV, open brackets. Now, when you do all these formulas, if you get confused, don't worry. If you get that first part right, it'll tell you exactly what to put in here. So the rate is your discount rate. So next it's the rate. We'll click on that, comma. Next we need the values, the money values. So we're going to use the adjusted cash flow, and then we're going to do comma, and we are going to need the dates over that period. We're going to close brackets. Now, there's one thing you can see here. It's 668 million, which is very, very far away from the terminal value. And the reason being is we exclude out the entry market value. So if we change that down to 0, that'll give us our sort of intrinsic value. Now we need to work back and figure out what the per share value is. So we're going to add back cash. So enterprise value is what? It's equity, debt minus cash. Let's figure out what the equity value is. It's the enterprise value. So we've gotten our enterprise value, our intrinsic value. We need to add the cash and exclude the debt, the reverse of that. So we're going to equals cash here. And then we're going to equals debt here. And then for equity value, we're going to, I have them right beside it there, plus cash minus debt. We're going to go equals. We're going to get enterprise value plus cash minus debt. And we're going to put that there with a big bold underline. And what we're going to do here is we're going to go equals. We're going to take this here and we're going to divide it by the number of outstanding shares. And then here we're going to take the market cap and we're going to divide it by the number of outstanding shares. And what that does for us is it gives us the intrinsic value of the company at $140.58 using the present value of future cash flows. And as of right now, the market value is 133. So it's slightly undervalued according to this model. So the potential gain loss is equals present value divided by the prior value minus 1. Let's just stick that division in brackets. And that'll give us a 5.42% upside potential. Now that doesn't necessarily mean that, $140 is the be all and end all target. It's just giving us an idea as to whether we're buying this at a discount to its fair value. It can definitely overshoot. How could it overshoot? Well, we might be wrong on the perpetual growth rate. That could be 2%. We might be wrong on the enterprise value to EBIT multiple. We took the average over 10 years, but it could overshoot up to 16, 17x, maybe higher. These estimates might be wrong. We might see that there's a big jump in GDP. As of right now, we're seeing real GDP trend greater than 4%. So we might actually see that these estimates are upgraded, right? So there's a number of things that could happen that could make this company exceed these expectations. So what's the point of a discounted cash flow model? It gives us an idea as to whether we're buying a company at a margin of safety or not. And if we can forecast some tailwinds to the business moving forward, this could be very valuable for us. How do we calculate the internal rate of return to understand these cash flows are very much irregular, right? So we want to understand the growth in those cash flows. So the way in which we'd calculate it is equals X, I, or, open brackets. And we are looking for the values. Again, we want to be looking at these values here, and we want to comma, and we want the dates, same dates. And that'll give us an internal rate of return of 8.63%. Why is that internal rate of return higher than the growth of fair value? Well, because the cash flows are irregular, so it's looking at the growth rates on an irregular basis moving forward. What this model tells us is that if we were to buy the company today at $133.35, it would be slightly below what would be considered its fair value. So that can give us, that's very informative to us as an investor in this business, because we might be buying this with a potential margin of safety, giving us some downside protection. Ideally, what would we do in this scenario? Well, if we're really keen on buying the Packaging Corporation of America, we'd be looking for the share price at 133 to maybe pull back a little bit, maybe down around, normally Warren Buffett wants a 25% discount to fair value. So if we pull up our calculator, we could be looking at 140.58 multiplied by 0.75. We'd be looking at somewhere in the region of, $105. 140 multiplied by 0.8, somewhere between $105 and $112 would be potentially a really good buying opportunity for the Packaging Corporation of America, using a discounted cash flow model and sort of those parameters from Warren Buffett. If you're interested, we also cover the balance sheet and the cash flow statement here on the channel. Thank you very much for your support and have a great day.